Hello and welcome everyone to another episode of the None of Our Businesses YouTube show and podcast. Today I have with me Nick Footer. Nick is the CEO of Intuitive Digital, which is here in the Portland metro area. They are a digital agency, digital marketing, and digital business that we're going to hear more about throughout the show. And so, yeah, thank you, Nick, for joining us. I appreciate it.
Yeah, my pleasure. Thank you for having me. I'm excited to talk with you today.
Well, let's jump right in there with talking about it, Intuitive Digital. Can you tell us about the company, what kind of services you offer, and who your typical clients are?
Yeah, so Intuitive Digital was founded back in 2012, and we offer a variety of services from pay-per-click advertising to search engine optimization, web design and development, and we have a variety of kind of sub-services under those three, but those are the three main services that we provide. In terms of who we serve mostly, so we really love working with nonprofits and EDUs, colleges, education, but we also have a pretty heavy focus on local businesses. So that's really where we started as an agency, is really helping small local mom and pop businesses. And so we still like working with those when we can. But we've also have evolved a little bit into more of like mid-sized businesses too. So we have a great way that we provide our services, and that is definitely scaled into larger organizations, as well as some still small. I've got a lot of love for small business, and I know a lot of them are hurting right now. So we're trying to do everything we can do to help them.
Mm-hmm. Yeah, I want to kind of go through your entrepreneurial journey somewhat here, and kind of, well, starting with how you got into digital marketing. How did you get into this field?
Yeah, so I'll take one step further back, because really what happened from an entrepreneur in general versus getting into digital. So my grandfather started a business in the 40s, which was a mops and brooms company. My dad ended up basically buying out my grandfather to become second generational owners. And it was my plan to potentially become the third generation and work for that organization, for what's now, and I believe it's still operating, although they have sold it since then, called it was called Easy Day Suburbanite or Butler. So you'll still see their mops and brooms like in Target and Fred Meyer's and a few other places under like Mr. Clean, and they also have another brand. But they sold it right as I was going into college. And so I already had this huge interest in business and operations, and what I realized, and I was like, well, now I can decide whatever I want to do. And at that point, that's right when social media was like becoming a thing. That was 2004 or so. And Facebook was just coming out. MySpace had been around. And what I really loved about the marketing side of things is just how you could connect with a user base in a way you could never before. Before like the social media, you could never really talk directly to necessarily like your customer or client in an easy way, unless they were like you were at their house doing a service for them, or and so that was something that really intrigued me in terms of like being able to connect more deeply with the target audience. And so that's really what got me into marketing is social media. And then when I graduated, I was one of 11 people who graduated from PSU in 2008 with a degree in internet marketing, which, 2008, the internet had been around for a while. There were 1,700 people who graduated with business degrees in my class, and only 11 decided that internet marketing was going to be a thing. So since then, those programs have expanded immensely, and many, many more people graduate with those types of degrees. But that was my focus in college. And then, I worked for a couple of agencies out of college also. So yeah, I went all in. I loved marketing, and I wanted to work for marketing agencies. And I just love the amount of data that you can get from digital, and how you can use that to help basically clients make more, get more leads, make more money, and grow their business.
And we talk about 2008 and that being, somewhat unique in the sense of the kind of degree that you were coming out of school with, but also, I mean, you were starting your career in our last Great Recession, essentially.
Yeah.
And yeah, so do you think do you reflect on that, or does that kind of speak to you in terms of how you might be handling current times and issues? We're doing this interview now in the midst of the coronavirus crisis.
Yeah, I mean, it definitely, it was good to go through that at the time. And I think it's helped me realize that we're going to get through this. This is not although this is really hard, it's very hard. Many businesses are completely shut down. So I'm not by any means diminishing how the impact of what's happening, but living through that, knowing that there will still be jobs, there will still be growth, and we'll get through it and recover and grow as a team and as a people because of it, I think is definitely positive. It's hard to see the positives sometimes. Right when you're at the worst part of like the change, cycle, right? Where like a lot of people are in the very bottom of that change cycle. They don't see a way out yet. But I do, I feel like there is some positive that's coming out of this already. And we're just going to try to do our best to grow through this and help our clients the best we can, so they can make it through also.
Kind of thinking about your family's business, your family's prior business, and entrepreneurship being essentially kind of in your family and in your blood. Yeah. Was it then a foregone conclusion that you were going to own and operate your own business? Was that always kind of what you were thinking?
I think for me, yes. That was definitely part of my personal vision. I have brothers and sisters. I don't know if they had that same feeling. They both don't own their own businesses as of yet. They may in the future, but so for me though, yes, it was a foregone conclusion. Even though so part of my plan was to work at a couple of agencies and then maybe start a business after maybe 10 years of working in the industry. And what ended up happening was I ended up getting laid off at my agency that I had been working at. And I was like, well, why not try it now? And, one of the things that I was really passionate about was testing out running a business that was really based on values and purpose. And, there's something that's been really popular over the last few years. It's come about. It's called a benefit organization, a B Corp.
Uh-huh.
And that was something I'd never heard of back then. But in large part, that's kind of what I wanted to run, which was an organization that instead of just being focused on shareholder profits, to be really focused on basically your entire value chain. So helping grow your vendors and your employees and obviously your clients, but your environment, your community, really like having an impact on many, many channels. And, we are currently in the process of completing our B Corp certification, which is really difficult. It is not an easy application process. It's been about 6 months, and I think it sounds like we've done enough work now to where we'll be able to get certified in the next month or so. Or submit, and then it takes some time. But that's been really cool process for our team to go through. And I'm excited to be able to announce that officially when it does happen. It hasn't officially happened yet.
That's great. So I noticed in your resume and in your background that you were the chief operating officer for Starship Coffee. I'd love to hear a little bit about that role, and maybe if there was anything that you learned during that experience that you were able to apply to leading Intuit Digital.
Yeah. So that was a business that my wife and I started. Actually, it was a side hustle. I don't know if any of you, if you've read the 4-Hour Work Week, but it was kind of an idea that we wanted to create a business that her and I could work on together. We had tried her being an employee of Intuitive, and that that didn't work out so well. So we wanted to do a business together, basically, where we're on equal ground. And that did work well from an operational standpoint with her and I, and she was the CEO. And, in terms of things that I learned, I learned a huge amount about how difficult starting an e-commerce business is. That is definitely not an easy thing. And I think that's in general in business. Like, if it was easy to run and operate a business, more people would do it. It's not an easy thing. So that was really hard, and just generally learned a lot about packaging and much more deeply about branding and shipping and things that, as a digital company, like I had no concept of, in terms of inventory control and a variety of other items that as an actual product-based business that I had to learn. So, in terms of what I can apply that to Intuitive, we have e-commerce partners, or we call our clients partners. And so some of our, strategy, I've wrung out some of that experience into how our strategies unfold now. But I think the other thing is that I learned is, like, you can run a business with your significant other, which was a goal of mine, and we were able to put a check mark next to that, which was great too.
So, talking about the business of Intuitive Digital, it seems like digital marketing, digital agencies, this is a pretty competitive industry, right? I'd love to hear kind of what you see as what is your company's competitive advantage in this space?
Yeah, it is very competitive. I think there's over 250 different digital agencies in the Portland metro area alone. So yeah, there's a lot of them, some small, some big, obviously. And, some of our advantages, I think one of the biggest ones is just the ability, and the way that we've run our organization is the retention of our team. So in digital, it's very, you're very likely to have retention rates in the 50% range year over year. And that's just because of the way that agencies work and how employees a lot of times will move to other companies to grow or to, to make more money. And one of the things that, our goals for retention over the last 2 years have been basically 90%. And we were very, very close to that last year. I think I forget the exact number, but we have very high retention of our people, and that allows us to, it keeps our account managers, so like our partners, have the same point of contact with one person, which is huge in our industry. We were able to keep, as the people that are doing the actual work, which allows us to not invest as much in training, and allows us to do normally better work. It allows accounts to have more like consistency across a strategist who's been working on it for years, months, and all those really turn into both also higher partner retention. So our partners stay with us longer. So that, yeah, I think retention is a big one. And you see that like in our Glassdoor reviews. I think that's a great place to go see how an organization is run. Of course, I have great Glassdoor reviews, so I would say that. So that's a place I like to look when I'm like potentially like looking, if I want to work with a new partner, I'll go look at their Glassdoor to see, how are they treating their employees. I think that's an important thing. Is like we have something called the Intuitive Way, which is the process we do digital marketing, and that's having that documented, and then we constantly test it. So one of our 4 values is continuous improvement, and that's something that from a service standpoint, we're always trying to test new services, new ways of doing things, and then once we find winners, we apply that across all of our partners. And probably the last one that's an advantage is just we've really focused on doing exceptional work, which has led to really great reviews online, as well as some awards that we've won. Recently we won an award for our PPC work, and then another one for SEO work from the American Marketing Association. And we beat out some really agencies, we were just so proud of, that the team was able to kind of do the work that was that much better than the other people here locally was fantastic. And I'm just so proud of the team for winning those types of things. And we've won a variety of other, like, fastest growing and culture awards. And we were just voted top 100 best to work for here in Oregon. And so those are some of the byproducts, I think, of like the internal processes that it is as a team and as an organization. And they're just signals, of some of our advantages, I would say.
Thinking more about the team as one of the key competitive advantages for you. What's the size of your team? How many people do you have at the company now?
Yeah, so we have 15 in total, and those are really spread across our different services: PPC, SEO, and web. I have a VP of services. We have an accounts team also, so we have 3 account managers, account director. And then we have a director of operations as well, who is extremely helpful for me and has really helped evolve our company from like a HR, documentation, financial perspective. He's been amazing. Shout out to Dan Auerbach. And so, yeah, 15 people, and it's we're pretty flat from an organizational standpoint, but we also are trying to provide management opportunities for our team whenever we can as well.
And I think with the team and retention being kind of one of your key competitive advantages, as we talked about earlier, I think I already know the answer to this question, but or maybe I'll just say this as a statement. It seems like company culture is an important part of your overall strategy.
Yeah.
And so maybe I'll kind of twist that question into, how do you maintain, do you actively maintain it? Is it organic? What do you do to influence culture, I guess?
Yeah. So I am the CEO, but my other title is the cultivator of happiness. And so really, it's a huge part of my overall job as the leader and founder, is to drive that culture. I have to like infuse everything that we do with our values and with our purpose. So our purpose is to cultivate happiness. Our values, we've got 4 of them, are to build long-term relationships, continuous improvement, to create fun, and to do what's right. And so it's really like everything I do, from meetings to the fun things we do. Like, the team makes fun of me with a lot of times with like the different values and how much I use them. But what I love is when I hear them using those things, using those, hey, like, would we be doing what's right if we do X, right? Or, and really like seeing that it really has become part of our DNA is huge. And other things, like, we invest a lot of our time that we could be billing our partners for in volunteering. So we do quarterly forced volunteering together. We also do some optional PTO for volunteering if they want it, a day on their own every quarter. We do happy hours. We do a weekly huddle meeting. We started using a system called Bonusly. I don't know if you've heard of that, but it's basically a system where you provide points to other teammates for doing really cool things, providing great services, etc. And then that all shows up in our Slack channel, so we get to see when people are doing those things, and then they can cash that, those points in for gift cards or all kinds of stuff. So that's been really cool. Bonusly, we started this year, and then we also are doing right now a daily lunch hour. So obviously with COVID-19, we're all working from home. And one of the things that we were feeling we're really losing is like that connection with each other. And so we have 4 days of the week. It's optional, and not everybody shows up to it. But every Wednesday it's not optional, and everyone gets to come. And I love that, that time together, where we get to kind of laugh and have fun. And normally we answer a couple of like funny or awkward questions, and it's keeping us connected, which I think is so hard and important during this time. So that's definitely, it's an investment that I've decided to make in the team, and I think it's well worth it. I don't know what happened. At some point, maybe about 2 years ago, people started saying that, and using this term, the intuitive family, and like people say the L word to each other, which is really like, hey, like, I love you, like that's crazy. And it's something special, and it's something that I want to try to maintain and grow, because I don't think that that's the type of place that, that's not the normal experience for most businesses. And so, yes, I absolutely do everything I can to try to shape that and maintain it and grow it, because it is special.
Yeah, definitely probably not what's normal for a lot of businesses. It sounds like you've got an extra, an exceptional cultural environment there. I really appreciate your sharing with the audience the very practical and tactical things that you do. I think that's definitely helpful to people who maybe think similarly and would like to follow your example and see what they can do in terms of building their company cultures. Welcome back, everyone, to another Roundtable session as part of the None of Our Businesses YouTube show and podcast. As always, I have with me here Charlie Zigmund.
Hi, everybody.
And AJ Wheeler.
How's it going?
And we continue to be conferencing, Zooming from our home offices to get together and have this weekly discussion on current events. So let's take it away, guys.
The Zooming reminds me of the old 90s song, Zoom, 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 and a boom, boom. We'll shake with the articles. Anyway. My first article actually that came across my time.
There's been some jokes and stuff going around, of course, for, so now the saying is, are we discussing the elephant in the Zoom?
The elephant in the Zoom.
Let's let that one die right there.
All right, go ahead. Sorry.
It continues my longstanding assertion that accounting jokes aren't funny.
No.
Although that wasn't specific to accounting, maybe just business. Anyway, so CNBC. So this was actually, the article sounds much different than what actually is said. Surprise, surprise. But small business loans above $2 million will get full audit to make sure they're valid, Uchin says. So in speaking with the press during a daily briefing, the Treasury Secretary mentioned that he wants full audits of companies that took out more than $2 million. And so his exact quote is, "I'm going to be putting out an announcement later on this morning that for any loan over $2 million, the SBA will be doing a full review of that loan before there is any loan forgiveness. This was a program designed for small business. It was not a program that was designed for public companies that had liquidity," end quote. And so a couple things about his statement, I think, that caught me was, or the title of the article, I guess, and public persona about what an audit is and what an audit does, I think is the first thing that caught me as a former auditor. And the other thing that caught my eye was the fact that he's making the assertion that the program was designed for small business and it wasn't a program that was designed for public companies that had liquidity. But they wrote the rules, and the rules clearly stated that it was kind of for those companies because the rules were kind of written in a way that was so ambiguous. And I kind of wanted to get your guys' thought on both those issues, like kind of the public persona of what an audit is and does, and when that nomenclature is thrown around of an audit, of what that means to the general public versus what it means to an accountant and a business. And then kind of the fact that the guy that helped write the rules is now saying the rules didn't accomplish what they were intended to. So anyway,
I think that's silly. Yeah, I think to have control over how you pick the rules and to set up this program and then kind of sit back and lament about how things played out while you had control is just, very silly to me. And doesn't seem, it's kind of a thing we talked about in the prior podcast, but yeah, it seemed like they should have had more thought put into what the qualifications were so that they didn't end up with an outcome that they really didn't want. And so, yeah, I think that's is an interesting stance to take once you've set up the program,
And I think, yeah, I mean, I think that, we talked a little bit about this in one of our previous shows too, about these rules and the ambiguity. I think this article just kind of doubled down on what was an ambiguous rule, and yet Mnuchin talks about it as if it should be clear as day, right? So, I mean, the rule was that you had to certify that you believe that the funds were necessary because of the uncertainties created by the coronavirus crisis, right? And so, I mean, that's a pretty open-ended, that you believe that they're needed, and that need results from uncertainty due to the coronavirus crisis. I mean, that seems like it to be able to establish that you need that, and then to certify that is a very open-ended kind of statement, right? And so then he goes on in this article, he goes on to basically say, he acts as if it should be common sense that if you're a public company with access to the public markets, that inherently means that you just don't need it, and that you just don't face uncertainty you have enough liquidity that you don't face the kind of uncertainty that they were talking about due to the coronavirus. And so I think, yeah, I mean, I would say maybe that's obvious to 90% of our audience as well, but being somebody who likes to draw within the exact lines given of the letter of the law and the rules that we deal with, it's not, I don't think it is that obvious. And if you're going to say that that's obvious, then is that where you stop? Is it just that public companies obviously don't need it? What else might Mnuchin or somebody else later say should have been obvious that somebody just didn't need it, right? And so I think that I find that kind of disturbing, because there is no bright line there, and I wouldn't say that being a public company didn't make that particular piece a bright line. And this is also something we talked about in one of our prior shows. I think the other thing that's disturbing to me on this is that they seem to be conflating this idea of liquidity and need and uncertainty due to the coronavirus with whether you're a big company or not. Those are really two different issues, right? I mean, if he's basically saying these public companies shouldn't have certified that they needed it because they had liquidity and they had availability of funds due to the being public companies in a public market, okay, but that's not a size issue. I mean, yes, there is a correlation between bigger companies being public companies and smaller companies often are not public companies, but there's small public companies and there's some pretty big private companies too. So being a public company or not being a public company is not inherently is not the size thing, right? And so it just sounds like a political soundbite more than like a technical definition still. And I don't think it furthers anything in the discussion on that particular point.
And I think really it comes down to those two key phrases, right? Certifying good faith, and then also it was necessary. So given the global pandemic and kind of the uncertainty of all markets, including lending markets, capital markets, the only thing you could really count on as being certain was cash, money in the bank. I don't think any large company could have sat there straight-faced and said, we have access to a capital market we know we can tap, or a debt line or an equity line that we for sure can tap, or have, in good faith know it'll be there.
100%. Yeah. Yeah. The idea that because you're a public company that you had certainty, that you had liquidity for the next 8 weeks, given the situation that we're in. I mean, that assertion by Mnuchin alone doesn't really totally make sense either. So yeah, I think 100%.
Yeah, it's silly. I mean, all these companies set their burn rates up around what they're spending and using. So yeah, there's no level of certainty that comes with being of a certain size. And yeah, it just seems like a silly stance to take. but I also appreciate just the idea of having to put out a soundbite that applies to a large, subset of businesses and trying to say the right thing that would apply. And so, yeah, it's kind of hard to give a technical definition in such a quick soundbite. And so I think he gets kind of bit by that a little bit.
Yeah, I mean, look, we work with small businesses. I support small businesses. So I definitely don't want to sound like I'm on the side of, oh, this support should be there for large businesses, and yeah, it burns me that large businesses, the way it was set up, large businesses were able to take this money and it detracted from the pool that the small business community had available to them. I do feel burned by that as well. I don't like that scenario. I think to blame it on the public companies to say that they just didn't understand or follow the rules correctly is just the wrong blame. It's like what you started with in the question, AJ. It's the Treasury. They wrote the rules wrong. That's who we should be blaming here.
Yeah, and I think it really points to the lack of specifics that were given in the original round of funding, because it was this kind of open-ended question like, in good faith, can you certify your uncertainty to meet payroll? And I think everybody in this country, or every business in this country, could have probably made that case, And even the caveat saying it's unlikely that a public company with substantial market value and access to capital will be able to make the required certification in good faith, and such a company should be prepared to demonstrate upon request the basis for its certification. I think it goes back to exactly the certification, the requirements to get certified were very broad. You bring in what your payroll was, you in good faith sign that you needed it, and then that's that.
Well, and it also kind of just speaks to one of the challenges of trying to distribute aid during a pandemic. I mean, one of the problems is that they may believe a lot of these things about that companies should be able to certify with more accuracy, or they may want a system in place that allows them to perform deeper audits and understandings, but it's just they don't have the time to set up those kinds of systems. And so they have to set up rules that are, under thought out, I guess, in order to just get the system to run quickly. And so, yeah, that kind of transitions well into my next article, which comes from Reuters, and it's called U.S. Payroll Protection Program, What Has Changed in Round 2. And so this article takes a look at what they've, the initial pot of money that was given to the first round of PPP loan funding has run out. And so they're replacing it with a second round of funding. And they've made some changes to the rules to try to ensure that a lot of these things we're talking about don't play out the same way. Some of the things that they did were they made it so that it was that the funds were bracketed by size of assets of the companies. So they had 30 billion for companies under 50 billion in assets, and then 30 billion for companies between 10 and 50 billion in assets. And so it's just generally trying to set up a better structure so that the money goes to the right people. Another interesting characteristic they added was that not more than 10% of all overall PPP funding could go through any one bank. And this was just to ensure that one bank didn't take over most of the funding. And so it talked about some of the challenges that they had in the initial batch, where they had problems with people being able to even submit their applications. And so they're implementing a new system that allows the banks to batch their applications together. And so they're going to submit like 50 loans at the same time. And that's supposed to help them then get their applications in timely. And so, they said publicly traded companies can still apply, but they have to, like you said, certify that there is some level of uncertainty, which still seems, difficult to clarify or to say with, in a way that doesn't apply to every business. They did mention that hedge funds and private equity firms were speculative in nature and therefore couldn't apply for SBA loans. And so they've specifically taken that out. But yeah, I guess I wanted to get your guys' thought on whether or not you think these type of changes are going to be successful in implementing the outcomes that they're trying to do, which is to get the money to small businesses.
I think one of the changes that you kind of mentioned, but that I had heard of as well, was that they were earmarking funds specifically for small community banks. So they were basically trying to make sure that there was a certain amount that would go through them. And the theory on that was, well, if they're if they earmark some of the funds specifically for small community banks, then that's more likely to make sure that it hits small companies. And yeah, I guess in the macro, what struck me about that is that that's not like, that's kind of counterintuitive or counter to my personal experience. But I can see in the macro where that might be true. So I'm not saying it's not true in the macro, but I know kind of in the micro, in the world that I live in, in the first round of the PPP, it was actually the businesses that were slightly more sophisticated, that had good kind of relationships with community banks, that actually got funded on the first PPP. It was those of businesses, including my own, that really treated banking, a lot of small businesses, micro businesses, you might say, I think treat banking as a commodity. So they don't go establish relationships with like some community banker, right? They don't, they just use a commercial bank. They use Chase or Wells Fargo or Bank of America or whatever. And I believe that's probably true for a lot of micro businesses across the board. And so I think that particular move by the SBA, probably, or not by the SBA, but by the rulemaking in particular, I think, I don't know that it really exactly serves the purpose that they're trying to make it serve, in the sense that funding it through community banks does a lot more to help community banks versus big banks than it does, I think, to help small versus big business. They could tackle the small versus big business a lot more directly by just putting more specific requirements on what it means to be a small versus big business, right? They could put requirements on revenue and assets and things like that. So yeah, it feels to me like there was probably more of just a community bank lobbying effort that caused more of that to be channeled through community banks. And it probably is true that in the macro that community banks don't serve the largest companies in the country. And so that probably does mean that by earmarking funds that way, you do get more small businesses than funds to large businesses, at least for that particular chunk. But I think it kind of misses the people who were underserved, because I suspect that a lot of people who are underserved in banking, it's not because they bank with community banks. It's because, like me, they treat banking as a commodity and they just use some commercial bank that happens to have a branch around the corner. And now that's biting them in the butt because they don't have a relationship to use to get at the front of the line.
Well, and it's kind of interesting too, because I know that, like, from my personal experience with trying to help companies get this, there's a relative relational thing that's going on where it's like, yes, you might know Bank of America, you might have accounts with Bank of America or some other gigantic bank, but to them, you are small relative to their other clientele. And so what you're really seeking for is a differential where you are the larger client of a smaller bank, so that you have that chance to get to the front of the line, kind of a deal. And so it's just this interesting give and take on the relationship that that it's hard to manage from a regulatory perspective, it looks like.
And one other thing I think that is not really kind of said to the layperson out there, I think a lot of the business operators who may listen to this get this point, but when we talk about having a relationship with a bank, the most likely reason that any business has a relationship with a bank is because they're already borrowing money from the bank. So this whole thing already put a bias towards people who were already borrowing money. Any of businesses that weren't borrowing money, that all they did was use the bank to deposit funds, they probably didn't have much of a relationship with their bank or their banker. And that left them out in the cold. And that seems a little bit counterintuitive to me, that if you've been hitting up the SBA previously before coronavirus and you've been borrowing lots of money in various ways and growing your business, you're already in debt. You got to the front of the line by already being in debt. Right? I mean, that's actually the scenario. Those of us who weren't in debt to the bank from a business standpoint, we don't have relationships with bankers because we're not in debt to them to begin with.
Well, there's no better way to be better at getting into debt than to have practiced getting into debt before, and sort of puts you ready to be more in debt later.
That's right. And leave it to the U.S. to basically encourage us to be more in debt.
That's what we do best.
Yes.
So yeah, kind of just branching off that, I had an article that was kind of a follow-up to this, but from a different source. It was an NPR article called "Small Business Loan Site Crashes on First Day of Funding." So I just get a kick out of the idea of, like, I guess not a kick, but I mean, there was all these challenges. They make all these changes. They come out with a new system that's supposed to help the second round go better. And then it's plagued with its own set of problems. And so a lot of the complaints were that the site that they used, the SBA site called eTran, wasn't allowing them to submit applications. There was a bunch of banks that said they had like 13 loan apps and they could only get one to go through the whole day while having their whole staff like just trying and refreshing. And then the article also talked about how the banks had gotten criticism for having received $10 billion in processing fees for the big banks in relation to issuing out these loans. And I guess I got kind of a kick out of that just because it's interesting that I may be wrong, but I think that the payroll or the processing fee that the banks got was also mandated by the legislation. And so it's controlled. And so again, it's not a valid point for criticism if it's built into the rules. And then the second thing is like to think about the processing fee in relation to, to say that 10 billion is too much of a processing fee. I think that that's not enough of a statement. Everything has to be scaled back to what exactly happened and what is 10 billion as a percentage of the total funds that were given. And also, can we really say what the correct percentage is? Do we really have a good grasp of the, what is a adequate processing fee for a loan like this, given that we, as spectators don't know everything that goes into it. And so I guess I wanted to get you guys' take on whether or not 10 billion in processing fees is controversial for a loan of this type in a circumstance like this.
Charlie, this speaks kind of what I mentioned in the first article, that I think the context of this meeting is skewed when you just throw out a number like $10 billion, because that sounds large and astronomical to anybody. And they're like, why does banks need 10 billion more dollars? They make millions of dollars every minute. But I think if you look at it from a context of like a commission on a loan or something like that, you have to take that 10 billion into context of 10 billion of how much, what percentage is the bank taking in. And I think if you knew the full context of that number, it would probably sound a little more reasonable than just $10 billion. And I think it's the difference between the public like having an idea, words being inflammatory or having like a clickbait message to them. I think 10 billion sounds a lot better than whatever the percentage is that the banks are getting. So
yeah, totally. And the other thing I thought about is, as I was just reading that quote, was that, I mean, the money going to banks isn't inherently a bad thing either. I mean, if it's not in this form, then is it not true that those banks will eventually be bailed out if they aren't, getting what they believe, what they need to operate, basically? And so I kind of read it as like, yeah, we can give it to them in a processing fee and have it be useful, or we can not, and then give it to them anyway in another form, And so, yeah.
Yeah, 100%. I'm on the same page with you guys. I mean, that just throwing that number out there like that, it feels like clickbait more than being meaningful without more context.
And I have to go back to the first article. I know I'm going to get on my auditor soapbox here, but when they're talking about being audited for these, or the SBA doing an audit or a review of what's going on here, it's unclear what type of audit they're doing. For the general public to know, an audit isn't going to tell you where every penny got spent, or it's not going to ensure that all the rules and regulations were followed to a T. It's going to give you reasonable assurance. So what that means is they're going to look at a bulk of the transactions that happen that are material above a certain dollar threshold, and they're going to render an opinion on how that money was handled. It's not, I think, what the public thinks of like when they think of an IRS audit or a forensic audit or any of those other kinds of audits that are done. I think specifically when you're talking about auditing for a loan or something like that, you're talking about a fiscal audit or a compliance audit. And those things are very different, I think, from what the public knows or conceives in the word audit. And so I think that's something to keep in mind when they throw out, like all these loans are going to get audited, and what that means, really means.
Yeah, I mean, I think that's definitely, it was an example of them throwing out something that sounded good, but actually when you dig into it, really doesn't mean anything, right? So, when Mnuchin says we're going to have these things completely audited, he's not using, he's presumably, I don't think he's using the term they're going to be audited in the accountant's sense, they're going to be audited. He's not saying, oh, they're going to follow professional standards of auditing, and they're going to kind of do any of the things that you might expect if you were, from a professional standpoint as accountants, saying that there was going to be an actual audit. It's just that layman's use of the term audit, and he actually used it interchangeably with audit, and then later he said asking the SBA to do a full review. So, there's no there's no expectation from my perspective right now that phrase that these are going to be completely audited actually means anything. We don't know what it means. It's one of those things that sounds good, but you don't know what it means until they actually get into the details of what exactly they're going to do.
Well,
and who's going to do it.
Right. In this case, because we had guidance that was published and then had the guidance change as we were trying to understand it. And so I think that when I think about what an audit would look like in this case, I would want to see just a performance of the rules. Just somebody checking to see that this person understood what their payroll costs entailed. And because there are a lot of little finer points for confusion as you try to interpret those rules in good faith. And so
Yeah, I think for sure it's going to revolve around who they ask to do this review or audit or whatever they ultimately call it, and how much budget they have, right? And that's how much budget in terms of dollars and time they can spend on it. Because if they basically put it in the SBA's camp and they have a limited budget to actually do these reviews, they're going to come up with a set of procedures that they perform on their own that may or may not really get to the bottom of what they're asking anyway.
Totally. And if you think you were mad about the processing fees for people issuing the loans, wait till you see the audit fees for people trying to verify that people actually did the loans correctly, because they're going to be bigger than the processing fees. Yeah.
Well, there was, we don't have all the information, so I hesitate to even bring this up, but on those lines, there was an article that I saw where Congress had authorized an increase to the Inspector General's office for the purpose of reviewing whether the funds granted under the CARE Act in totality were being spent as intended. And it said something about how that office had like 92 auditors, and they increased their budget, and I don't remember what the number was. They increased their budget sizably. The Inspector General's office said, well, they didn't expect that necessarily meant they were going to be bringing on a lot more auditors. But yeah, I thought about it. I thought, well, 92 auditors sounds like a lot, but when you're talking on a nationwide program and really determining whether that money is being spent the way Congress intended, to me, it'd probably take way more than 92 auditors. You'd be probably talking in the thousands of auditors to really make that kind of determination. But I don't know. I've never been in the business of auditing. Those government auditors that do that kind of thing, they're pretty good at kind of figuring this stuff out and reporting back to Congress on a lot of things. So who knows?
All right, everybody. Thank you for watching and thank you for listening. Come back again next week and we'll go over more business news. It's been the None of Our Businesses podcast. And thank you for tuning in. Have a good weekend.